appreciated in the market. And there are interesting things you can do, whether it's looking at the Saudi Real or other markets around that. But I think for generally, I think a lot of investors look at what happened in the 70s and 80s, and they look to gold, they look to oil. They don't exist today like other markets that are newer technology. Even something simple like the Treasury inflation protected bond market, those are sometimes called TIPS. TIPS only started in 1997, right? It's a pretty new market. They didn't exist in the 70s and 80s. So I think the one flaw when you look back at saying, all right, what happened in stagflation? What worked in inflation? What worked in the 70s and 80s? You're kind of leaving out a bunch of asset classes that are available today that I would say are newer technology, even things like the US swap market. The swap data really doesn't go back before 1988 is the longest I can get data from on Bloomberg. There's really not data before then. So although there were bonds and government bonds, there wasn't really that unfunded levered market like there is today. So I think it's just really important to not look at just back testing and what worked previously, but really think about when you're constructing portfolios, what are things that could work? What are things that are newer technologies? And how do you create a portfolio that's kind of diversified for a lot of different environments? I mean, even if you're the most deflation, focused person in the world, your portfolio might be completely constructed to benefit from a deflationary environment. And therefore, it might make sense to have some inflationary assets just in case. Because at the end of the day, you don't want everything to go down together. And I think that's the big point behind portfolio diversification.
One point, because we didn't have you when the IMF information came out, and then also the Fed, Williamson spoke out. With IMF, as you may have seen, they cut their GDP forecast. I think people were very skeptical on stage. Would love to get your thoughts on their forecasts, specifically, the global economy heading for weakest growth since 1990. What are your thoughts on that?
Yeah, I think generally, all forecasts are forecasts. So no matter who's making the forecasts, whether it's a individual on Twitter or the IMF or the Fed, a forecast is simply as good as the data, and nobody has a crystal ball. And even if you could perfectly predict outcomes, say political outcomes like Brexit, you might have been completely wrong and lost money based on the way markets move. So I just think it's very difficult to do a lot of forecasting or believe forecasting, because if everybody starts to think, oh, there's going to be a recession, for instance, let's just take an example. Say everybody's right and you expect a recession, therefore everybody goes into, I don't know, cash, and then the recession happens, you could actually see a rally in risk assets just because everybody's not invested, right? So it's very, very hard. I'm just taking an extreme example. It's very hard to make money off of forecasts being right, and even getting the forecasts right don't necessarily mean that you benefit financially from those investments.
Yeah, one of the things that we're trying to, Darren, would love to get your thoughts on the IMF forecast. I agree with Nancy that forecasts are only as good as the forecasts are, which means that they're not that good. But would love to get your thoughts, Darren, on the IMF data. And Bob, thanks for joining us again. We'd love to get your thoughts as well.
Yeah, no, thanks for having me on here. I think, overall, the global economy is going to have a rocky road ahead. And, the reason why I think that is because inflation is slowly falling, but, economic growth still remains historically low. And so when you have inflation slowly falling, economic growth at historically low rates, then that's where we start to see financial risks start to rise. Now, Bitcoin overall is still like 31% off of its high for 1 year. When I look at, different ratios for Bitcoin, I'm looking at it as an alternative for gold priced in US dollars. And we're at, some lower ratios there. I also look at Bitcoin as a risk asset still because of, those drawdowns and some of that asymmetric return profile relative to, say, the S&P 500. And for me, we've talked a lot about real assets. We've talked a lot about gold. We talked a lot about Bitcoin. Something that we haven't talked much about is, dividend paying stocks. And so as, we're under a nominal regime, as we're under an inflationary regime, the idea is that these dividends are a consistent cash flow payout, something that you don't usually get in venture capital, something that you do get in real estate. But the difference between dividend paying stocks and real estate is the fact that the maintenance cost for real estate is much higher than it is in dividend paying stocks. And so that's just, something that I think the panel hasn't touched on, that is something to consider as well. Just as these costs increase, as maintenance costs increase, dividend checks, are something that can come in the mail, that can keep up with inflation as corporate profits, stay steady, under a challenging environment going forward.
Yeah. Would love to also get David. You said, I'm sorry, Bob. Go ahead. Why don't you chime in, and then we'll go back to David.
I was just going to mention one of the asset classes we talked about. You guys talked about gold, precious metals, and silver, and so forth. But silver is actually probably one of the cheapest assets on a relative ratio basis. I guess if you look to gold, to S&P 500, it's actually cheaper now than it was back in the early 1970s, when it was at 75 cents an ounce compared to the S&P 500. But what's interesting with silver is that the inventory levels that you're seeing on the exchanges continue to drop. And for example, you're sitting at 35 million ounces of inventory, and backing all the futures contracts right now on the registered category. That can be taken out in a heartbeat when you're talking about a size of a market compared to, for example, the kind of money that goes into a tech fund or something like, or just in general assets overall. It doesn't take a lot of money to move this market. And I think what you've been seeing the last 4 or 5 years is a move out of paper instruments, a deleveraging going into the physical world. And that physical world is not just simply saying, hey, listen, I don't trust the system, but it's also a lot of high net worth individuals, a lot of people starting to say, listen, I don't know where political policy is going to be 2 or 3 years from now. You're going to see in 2025 the reversion of the 2017 Trump Tax Act, where all income tax rates are going to revert back to what they were in 2017. There's going to be an idea of more of a return of your money scenario than it is a return on your money, where people start to hoard a little bit more, because if tax rates do start to rise, especially on the capital gain side, there's not going to be as much risk taking. All these things have factors, but most importantly, you're starting to see the tax withholding data, payroll tax withholding data just went negative year over year. And that sort of pretends that the employment picture is already starting to weaken, and that it's the recession that'll actually move the metals and a higher unemployment picture than it will be if the economy just hums along or you have stagflation. It's really the confidence that the market will have in the Fed's ability to handle or weigh, do I protect the inflation or the economy, or do I fund the Treasury? And we all forget that the debt ceiling limit's going to be lifted sometime in June. You're going to get a wave of new debt coming onto the market, and that's going to create some liquidity conditions, I think, later this year as well.
So that's wonderful. Thanks, Bob, for summarizing. For everybody that's joining us, of course, right as we're about to end, everybody joins, which is great. But just want to let everybody know to go up there, join the newsletter. It's one of the things in the nest, and then also that we're going to be doing this space every day at 8 a.m. Eastern. We're going to summarize what's going to happen in the market. Tomorrow is probably one of the most important ones, with the CPI report coming out in the morning. So, feel free to join us. The big things that we spoke about today was business and consumer sentiment is worsening. We think that this is more indicative and a better leading metric for what's happening in the market. We think, I think across the board, everybody thinks that the Fed is moving too slowly, and then now, is potentially overshooting. And we think that there's been a flight to safety in the crypto markets from other possible shitcoins and stable coins into Bitcoin. And we think that this is going to continue. This is not financial advice. Wanted to end with that disclaimer, but we're excited that this is the first day and it was a great time. Scott, thank you so much for joining me. Thanks, Mario.
Thank you, Dennis.
And we will see you guys tomorrow at 8 a.m. Eastern so we can round up the market. Thanks to all the speakers.
And really quickly, Danish, just something we were mentioning in the chat. For anyone who wants to continue that crypto conversation, I am hosting a Spaces in 1 hour at 11 a.m. Eastern Standard Time. If you haven't been there, it's been pretty epic on a week-to-week basis. Last week was Balaji. Before that was Michael Saylor. And today is Mike Novogratz, the CEO of Galaxy, and Chris Giancarlo, who is the recent former CFTC chairman. So obviously, if you're curious as to what's going on with regulation in the crypto space, he literally was the chairman of the CFTC, who is now, after he's left, going after Binance, obviously, and he's working on a central bank digital currency project. So it should be a very heated and interesting conversation among all of them. So please feel free to join there in an hour.
Amazing. Thanks, guys. Appreciate it. See you guys all tomorrow.
Thanks, everybody.